So today we are going to discuss the revenue and impairment recognition. It's a very interesting chapter, and revenue recognition has additional information other than the one that you already know about methods. There are new things to learn. So let's start our discussion. Revenue from the contract with customers. We will see recognition of revenue over time and impairment and disposal of the long-lived assets. So this is related to revenue recognition, and this one is related to impairment. Impairment would be easy to understand because we already discussed about goodwill, and goodwill need to be impaired. So we will see. Let's start with the revenue recognition. Means when should you recognize the revenue at the first? There are key terms that has been added. This is just for a basic knowledge that you should know. When we say revenue, what does it mean? So in accounting language, the gross inflow of economic benefits means you sell something, you receive cash, or you create receivable, or any other asset. Maybe you sell a car and you don't get the cash. You exchange it against a piece of land, so it's up to you how you are going to handle, such as the sale of goods, sale of service, interest, loyalty, and dividends. So how we measure it? Measurement will be on the fair value. So fair value in American language, we call it as market value, because market value or fair value will be determined through a market value. So is either received or receivable. So this is fair value concept. US GAAP talks about market value, and IFRS talk about fair value. How we recognize the revenue? When we see it is probable that any economic benefit associated with the revenue will flow to the entity. Probable is a very open word, means when it is expected, and how it is expected, this is we will discuss. The amount of revenue that can be measured with liability. So this also need to be considered as a revenue. Okay, so like for example, unearned revenues means you have taken an income and it is not yet realized as income. So you have to think about that scenarios, which I will explain you shortly. Sale of goods. So it's a bit simple, like you went to a shop and you buy something, you exchange money, you got the goods, so it was a sale of good. Now the seller has transferred the benefit. Significant risk means I bought a car, I took the key and I came out of the showroom. So now car is mine. If I hit the car, it will be my risk. The risk of the seller has finished. And ownership also is a criteria. So either goods has been exchanged or ownership has been transferred. And very important, that amount should be measured reliably. So you should know that car, for example, $100,000, it is a price, and the flow, it is a benefit for the seller. So that is for sure. In a trade, there is a benefit of on one party at least. There are services, like when you join a gym, they say if you join for 12 months, you will get a lot discount. So what you do is that you pay 1 year in advance. Now think about a gym. Gym hasn't served you these things 12 months. So it is not an income for them. It will be a liability. And every month out of this liability, they will recognize a revenue. So liability of 1 year will reduce and the revenue will be recognized. So services are bit different. And For that, he says we go to the stage of completion, means how much services has been rendered, 10%, 20% we recognize, or the percentage of completion method, that is in construction contracts. The amount of revenue can be measured reliably, same condition. Economic benefit will flow, that is also the same condition as goods. So these are the either it's services or it's the sale. These are the criteria for the revenue recognition. Now, there are some businesses where you receive royalties. For example, you have a mine, you have a book has been sold all over the world throughout the year. So say 5% you agree with the publisher that any book will be sold will come to you. And dividends and for interest, provided it is probable that the economic benefit will flow to the enterprise and the amount of revenue can be measured reliably. So it's been repeated, same thing, but very interesting thing for you for solving some multiple choice question, that if it is interest, use effective interest method. If it is loyalty, then see accrual basis. And in terms of dividend, see when the shareholder right to receive payment is established. Generally, when it is established, when in annual general meeting, the shareholders or directors announce that there is a profit and they are going to give you the dividends. So these are some terminologies, and these are from IFRS, International Financial Reporting Standards. So how to recognize the revenue? This is a beautiful summary that you can see on your screen. There are 5 steps you have to take before you recognize a revenue. You can say step number 5 is recognize the revenue. So we generally say like that either goods has been transferred, ownership has been transferred, but in US GAAP and in IFRS also, they use these terminologies which is more fancy and nice. So it's gonna give you a feel of sophistication. Otherwise, the same thing that you have understood as transfer of ownership, risk transfership, and other things will be the criteria. So he says, identify the contract. That's the first thing. If you want to invoice contract, this is you need to see that what are the terms and conditions. Is there is a consideration, there is a price, there is a term of there is a warranty or not. These kind of things you can see in the contract. Then see what are the performance obligation, because I give you example of a gym, like you are in a gym, 1 year advance payment you have given. So what you are going to do? I mean, how you are going to handle this scenario? This is so you need to know what is the performance obligation, means when the revenue actually will flow to your organization. Price is very important. Transaction price, you know that for booking a debit and credit, we need an amount. So you need to determine the price, because without price, then we can't recognize the revenue. And this is a step number 4, allocate transaction price. Allocate means, for example, if there is $100 million contract, and this year around 60 million has been performed as an obligation. So this amount need to be allocated to earned revenue or unearned revenue this way. So all chapter is following this diagram, and I can see that you can easily understood that it is a very easy mechanism, that see what is the invoice contract, see what is how the sale will be done, and determine the transaction price, allocate and then allocate it what is earned and unearned, and recognize your revenue. So it's a pretty straight and forward-looking approach. But of course, being a book reading, we have to go through one by one. So I'm gonna discuss first step 1, 2, 3, 4. Any question, you can stop me and ask. I can.